on
Yeah,
outside.
it's a little bit of a thunderstorm situation here. So, but we wanted to get back into this.
Our office does not have a generator, unfortunately.
Oh my gosh. All right, so let's get right into it. What are market cycles?
Yeah, so like we said, things are cyclical in real estate, and that's really in most things in life, right? There's points in time whenever there's a lot of demand, a lot of interest, right? And supply and demand drives prices. And so if you have supply down and demand up, it's probably a hot time, vice versa. But now, right, as costs are going up, right, interest rates have had to go up due to inflation. So what's happening in real estate? You're seeing a softening in real estate across the board, right? And so again, it's
what
cyclical.
does softening mean, though, right?
Softening means pricing. It can mean costs go up. It means demands go down. All of these things can happen each all at the same time, independently.
And I think right now what we're seeing is probably the demand. There's, instead of 30 groups, there's probably 5 to 10. Right, that are ultimately bidding on these properties, right? So doesn't necessarily mean that the property values initially are going down significantly. It just means that there's not 30 groups that are going to potentially bid it up another 10 and 20%, right? Which is what we were seeing up until, call it, probably 3 or 4 months ago, right? So, and that's ultimately how we were able to kind of get into some of the deals that we were now, right? Where we were able to negotiate a better deal because there wasn't as many people there. So, softening is definitely happening right now, but there's just obviously like everything else, right? You kind of get to a dip and then it starts kind of ramping back up, right? The great thing about multifamily, right, is the fundamentals haven't changed a whole lot, right? The only thing that's changed right now, and we've talked about this on the show in the past, is the interest rates have gone up, right? So, what are some of the key indicators other than interest rates that...
And really quick too, right? To add one more thing about real estate being cyclical, it's also area dependent, right?
That's true.
It's not just a blanket statement. We saw during the recent, oil crash, right? Or even let's go back to 2008, 2009, right? Big dip, right? Some areas actually still did pretty well, right? Kind of survived, right? Other areas didn't. And so again, with oil, now we're seeing different things. So realize that it's location dependent. It's not a one size fits all. And again, there might be, right now, there's probably a softening happening across the country, but that does not mean that there's not markets that are blowing up, going strong, and continuing to gain interest and momentum.
And that's where those market fundamentals, the apartment investing fundamentals, that is, are actually where it's still strong, right? Rents are still going up in the Sun Belt area. There's still population and job growth, right? Ultimately, right now, the only thing that really people are kind of seeing is that inflation is kind of eating into some stuff, and then the rise in interest rates, which essentially is tied to, in a lot of ways, it's going to not only necessarily single-family homes, but think about buying cars or your credit card debt. A lot of that stuff is going to be tied to that rate, right? Whereas commercial real estate is sometimes it's pegged to a different index as well. So anyway, beyond interest rate, what are some key indicators to see, hey, you're at the top or you're at the bottom or you're going up or you're going down?
Some of it is just looking at rent growth, right? What is going on with rent growth? As rent growth picks up, demand increases, right? That means, hey, you will get a better yield. And so you're looking at the cycle of rent growth, job growth, population growth, inflation. You're looking at cap rates. All of these things have different influences on what's going on with cycles. And so it's really important. And and it's also odd, you don't know you're at the top. You also don't know you're at the bottom. You just know that you weren't where you were last week or where you were 6 months ago.
You can't time the market, right? This is just like with your stock portfolio, folks, right? You can't sell at the top and then hope to buy at the bottom. It just doesn't work. Even supercomputers just don't get it right sometimes, right? Because the market is so big and unwieldy. And the one thing that Ferris really touched on that's probably one of the key takeaways of today's show is that real estate is super local, right? So what might be working in Houston might not be working in, say, Florida or North Carolina or whatever, or vice versa, right? Now we think ultimately all those markets are pretty strong right now, but again, point being is you could have more rent growth in a Houston versus an Austin or an Austin versus a DFW, right? You have to look at every sub-market and determine what is happening right then and there. So those are some of the indicators, right? Of where you might be in a cycle, right? Is it softening? Are interest rates going up or down? Is rent growth going up or down? Right? And then ultimately where are prices at, right? Are they softening or are they going up, right? Because I would actually question like, hey, if they're ramping up a whole lot, that doesn't necessarily mean that the market's good either. There could be some artificial demand, and I think in a lot of cases, what ended up happening last year is you had a lot of cheap money, right? And a lot of cheap money ran into multifamily because it's just a great asset space to be in, right? The fundamentals are there, like I talked about. And so whenever you have cheap money, people are going to go chase yield, and multifamily was one of the best places to do that. So you got to look at that, right? So what are some of the biggest challenges as well as advantages in today's market? And I think we kind of touched on some of those.
I think the obvious one, interest rates, right? Interest rates and interest rate caps, those things go hand in hand.
Yep.
Rates are high and we don't know where they're going to land, right? And so everybody knows they're going up, right? Expect to go up. Is it going to be just one more month? It's going to be another 6 months. Who knows, right? And so that's a challenge because you have a lot of money on the sideline, but then that presents opportunity.
Yep.
We're literally going through the pipeline and to figure out which upcoming deals just did not get much interest that sellers need to get out of.
Yeah.
Right? We think, we're talking about one today, 2000s product for 160.
Don't give away the
But nobody
deal.
needs to know what market it is. But I mean, 2000s product for 160 a foot. That feels
pretty
great.
good. That's pretty good.
And so again, starting to really look at those types of opportunities, right, and see what that looks like. So
yeah, and I think ultimately some of the challenges that we're seeing is just sometimes the news they sell the story, right? Which is, they try to scare folks into whatever thing might be happening at that moment, right? Because if you tune in to hear what tragic things happening, they're going to be able to sell ads. So I'd say look through the data yourselves, folks. Make your own determination, right? There's some things that, certain things like recessions haven't lasted, longer than 24 months or 26 months?
no, well,
Actually, maybe less than that.
Rates increasing has not gone on longer than 26 months ever.
And I think I actually saw something about recessions too, right? Where again, hasn't gone longer than like 18 months. So you have to look through the data and understand that yes, there might be a little bit of pain, in the next 6 months or so, but things are going to eventually continue to bounce back. And again, if you're investing in markets that are already strong, where you have that population growth, you have that job growth, you have a diversified economy, you have, people wanting to work there and do business there and live there, that's going to drive demand for people to rent apartments, right? So you need, and really just commercial real estate in general, right? Those are just the fundamentals behind commercial real estate. So if you have those going for you, those are going to be the markets that are going to continue to not only rise a little bit along the way, but are going to shoot back up when things really start kind of opening back up again, right? But I'd say the advantages are that you're definitely going to probably come across some deals. And so you need to have some dry powder. You need to be looking at increasing your investor list and getting those people dialed in, getting those people primed and ready, right? Because again, everybody's looking at the news, and the news is all about what's happening today. It's not what's happening in a month. It's not what's happening in 3 months. It's what's happening today. And what we always tell people is like, look, this is a long-term play. Most of our deals are, projected to be 5 to 8 year holds. Right? There's a lot that can be happening. Just think about what was happening 5 years ago, folks. What was happening 8 years ago? A lot can change, right? So don't get caught up in what's happening right now, right? And I'd say that that's probably an advantage, is that you can have that longer term horizon, right? So people kind of they've been asking us this the last like 3 or 4 months, right? Has acquisitions kind of slowed for you? I'd say it's kind of slowed just because deal flow slowed. Right? Not because, again, we don't believe in the fundamentals of apartment investing, but there hasn't been a lot of deal flow. I think everybody's kind of pulled back and said, hey, let's get through the summer. And then I would assume, assumptions, what they say about those. But going into the fall, people are going to try to get rid of some deals, right? Because there's always that influx of, hey, let's get a deal or two done before the end of the year. Plus you got last year of 100% bonus depreciation, which is huge. So you're going to have some demand drivers that are going to cause people to, get off the sidelines and actually sell their deal, right? But ultimately we've got our plate runneth over with deal flow that we were able to kind of get into and negotiate good prices on. So we're working on those this summer, right? So that's kind of what has changed in our equation. But we do expect to be a buyer, probably 1 or 2 deals in the fall as well. So what are we seeing happening next in the multifamily world?
Well, it's funny, actually, I'm going to answer this question that came in live. And so if you have questions, please ask them live in the chat. We will answer them here and go through them. But a good one that came in from our buddy Amanda basically says, in addition to interest rates going up, do you see leverage going down? And the answer is yes. Why? Right? Because today most deals are not leverage constrained. they are DSCR constrained.
That's
what
true.
does DSCR stands for? Debt service coverage ratio. They want to make sure that you have enough positive cash flow to cover the note and some.
Yep.
And so it's that and some piece. And so what do they do? If your DSCR is too low, they will keep dropping your loan until you hit a DSCR that hits what they're looking for. Usually that's 1.25. And so by default,
on the Fannie Freddie stuff. On the Fannie.
Even the bridge guys, they want to see your year one DSCR. I mean, right? It's all
but I mean, my point is, it's not 1.25 though, right? You know?
Yeah, no, but they want to see you at 1.25 at a certain point in time.
Yeah, to get out of the loan.
I agree.
Yeah.
And so, ultimately the answer is yes, leverage is going down. People are reducing yield, right? With reduced yield, right? Or actually, let me change it different. With increased debt, interest rate costs, right? They have to keep on reducing the loan to increase the yield to get it where it needs to be. Because again, they have to package and sell it on the back end anyways.
Yeah, and that's a good point. So let's talk about that. So what ends up happening, folks, is that you have these lenders, right? And the lenders aren't, for the most part, some of them do, most of them don't keep this on their balance sheet. So they loan the money out. Usually they're taking money out off of a line of credit. They loan it out. They package it up with, say, 50 other loans, and then they sell it on the CLO, the secondary loan market, right? And they sell that to a bond holder, right? Now, the bond holders are looking at risk, return, and all that goes into that. And so what they're also doing these days, because interest rates have gone up, they're also reducing the risk of the portfolio of loans by reducing that leverage too. So there's two things that's kind of happening. So it's all the more reason that you need to be able to raise equity to get into these deals, because you can't be stuck 2 weeks out and get a $3.5 million retrade from your lender that might have happened to somebody that we know, and not be able to raise the money, right? Or potentially, even on top of that, you have to renegotiate with the seller. These things are happening right now in real world time. So you need to understand that that is part of what's happening in the multifamily world right now, right? But what we see, obviously, cap rates, I'd say that they're going to probably inch up, call it 25 to 50 basis points if that hasn't already happened yet. Some people are telling me that it is. I'd also say that interest rates are probably going to go up, probably in the interim, probably give it next 3 to 6 months. Then they're going to level off, right? What the Fed is trying to do is they're trying to decrease demand. Therefore, they're going to try to quelch the inflation that's going on in this economy, right? And so the only way that you can do that is that you decrease demand, you decrease the amount of money going into the market, right? And you just almost have to throw, a wet blanket on the whole thing. And that's what they're doing by increasing the rate, right? That's only going to get them so far, because at the end of the day, you're going to start having a slowdown in the economy too, right? And as we always see, the slowdown is going to probably lead to, okay, we're going to probably, start buying up bonds again, and we're probably going to start decreasing the federal funds rate as well, right? So we see charts that are probably 24 months out where that interest rate's going to start creeping back down. Now, obviously, 24 months is a lot of time. Think again, what was happening 2 years ago? We were in the middle of COVID. So, the whole thing is you just really don't know. You just have to, ultimately mitigate your risk, have reserves, get the best debt that you can get the best insurance you can get, and just buy on the fundamentals, right? Don't assume that you're going to get 15% rent increases across the board for the next 3 years, and then you're going to taper off to 5%. It just doesn't work like that, folks, right? That's not normal. Now, I still see some rent growth in a lot of these communities, right, in these submarkets, but you're not going to be able to underwrite to that anymore, right? So you're going to eventually probably have, some more buyers get into the market. Again, I think that's probably going to be in the fall. And then going into 2023, depending on where the market is, you're still going to have liquidity, and you're going to still have people that are going to want to deploy that money into something, right? So I think that's what's going to happen in the next 6 to 12 months. Yeah. What do you think? No,
I think ultimately, yes, we'll continue to see rates go up, but I think the Fed is going to taper, right? By the end of the year, to stop increasing rates, at least drastically. So, ultimately, I like to tell people it's about reserves, right? And even then, we talked about DSCR earlier. You want to look at where you're shaking out on the refi, and just make sure you have plenty of cash, right? Typically, the only people that lose money in real estate are people that can't hold on to the deals, right?
That's true.
That's very. I know that's.
What do you mean by that? What do you mean by that?
It means that they had to exit a loan. They didn't have cash for the refi. All of the above, right? For whatever reason, they couldn't wait it out for a better part of the market cycle.
That's true.
And so definitely something to keep in mind. And even for us, it's top of mind for us on how much how much is enough, right? There's a lot of different schools of thoughts. Do you need 6 months of expenses? Do you need a year? Do you need 2 years? Do you need to cover debt? And that's, all these different things.
Yep.
That's a much bigger conversation for another day. But again, it's something to think about.
I think it's the most important thing, folks, right? Right now, cash is king. Having those good reserves. I'd say even making sure that you have some cash, reserves for your current deals too, right? Making sure that if things do soften a little bit more, that you can ultimately cover some stuff that might pop up, or have that money to be able to refinance, right? At the end of the day, there's a cost involved in refinancing. And again, Freddie and Fannie don't look at a forward-looking projection. They look at in-place revenue and expenses. So you have to be able to cover that debt service coverage ratio, DSCR. So you need to look into that and how that's going to potentially affect your refinance, right? But good point Ferris makes, right? The longer you can hold on, typically you're going to be able to ride it out to another part of the market cycle, which is going to be a little bit more lucrative. So, boom, got through that.
Yeah,
any other additional questions?
Comments, questions, thoughts, please go ahead and ask them. We are happy to help answer them live.
I'm sorry about
here.
that thunderstorm and the little lack of
All right, we get another
electricity.
good question. If you buy cash only, you never have to worry about mortgage rates, etc. Absolutely. With cash, that means you only need to worry about insurance. Even I guess you don't have to get insurance, but probably money well spent. Taxes is the only
you
thing.
absolutely should probably get
So you want to
insurance.
make sure you have what I like to call your TSCR, tax service coverage ratio. Do you have enough to cover taxes? That's all that matters. So,
No, if you have the wherewithal to do that on some of these properties, I typically wouldn't say that, but within the next kind of 3 months, maybe it might be an all right play, right? But again, I see interest rates coming down, and really a lot of this stuff gets juiced by, just having a good piece of debt on it too.
a good piece of debt, and really a good operator, someone
Yeah.
that knows how to structure deals and has been through challenges to help you basically.
And we've been through a lot. We have been through a lot.
I like to say we have a PhD in lending, which isn't really a PhD I want to have, but it's a valuable one to have.
And PhD in operating,
so
too. There's just
understand
been a
there's a
lot.
lot that goes into the structure of the loan, the deal, the partnership, what the refi looks like. Right? Again, it's always a time to buy in real estate. It's about getting through and lasting. So.
Absolutely. But we couldn't get through all this without talking about MFIN. Oh my gosh! Unless we got another question.
I got a few more questions.
Oh.
This guy over here is never patient. Let's see another one. John says, hello, do single-family home properties have a direct impact on multifamily assets, or will multifamily values depend largely on NOI? So, in short, multifamily is dependent on NOI. No doubt about it. That's how commercial real estate, whether it's multifamily or industrial or storage or whatever you want, is valued. That said, now you have to work backwards. You have NOI. NOI is about your positive cash flow. How do you increase NOI? Rents, other income. Now, if let's say all the houses in the country fell 40%, something significant, right? Well, guess what? Housing just got really cheap, right?
In some markets,
and so
not all.
Yeah, but I'm saying, I'm giving an example. So if housing gets really cheap, you have less renters in apartments, which means rents in apartments would go down and housing would go up. Vice versa. As houses continue to get more expensive, people will move to apartments, right? And so there is a relation there, right? It's an indirect relationship, so to speak. But again, the rents is tied to housing and availability.
And I'm gonna make two additional comments to that, right? Again, there's a supply and demand imbalance in this country, right? We have a lot of renters, and there's just not a lot of housing, right? And what I mean by that is not only single family. It's really there's not enough single family out there, and builders just aren't going to be able to keep up with the demand. There's not enough multifamily either. Right? So that supply-demand imbalance also keeps rent growth going in a positive direction, right? Because you have a lot of demand of people that need to rent, right? And so you have to kind of look at those things, and Ferris touched on, obviously, the price of housing and where that is in correlation with how much you can rent for. But I'd also say what I'm seeing is you have a lot of first-time home buyers that are trying to get in, or even maybe second home buyers, right? Interest rates are a lot higher than they were 12 months ago, right? So it's hard for them to now make that house payment. So what's happening? A lot of them are just deciding to stay on the sidelines. You know what? I'm just going to rent for another year or two, see if interest rates go back down, then I'll buy at that point, right? We're seeing a lot of that where people are just deciding to get out of the single family market altogether. I would say both of those things are positive for multifamily, right? So I'm not, when people are like, oh, housing's high, right? What they're typically talking about is single family housing is high. Right? And so if single family homes are $1 million and your mortgage is going to be $4,000 or $5,000 a month, that $1,500 in rent ain't that bad, right? And you don't got to come up with that 5, 10, 20% down payment as well. So people think about that. And as interest rates have gone up, their payments have gone up too. So now that $4,000 note probably is closer to $5,000 a month, so something to think about. But good question though.
All right. All right. Comments, questions, please ask them. Wait, we got some more. One said, I'm about to drop a few $100,000 on multifamily. Where do you guys recommend buying? I want to get $2,000 rent per $100,000 of spend. You're not going to get that.
Yeah,
not in any market we're seeing.
I'd say that's probably tough.
That's the 2% rule. But if you can hit the 1% rule, you're already very lucky.
Yeah.
I mean, realistically, that's not a very realistic thing in any of the markets we've seen or tracked. Maybe there's a market out there.
There might be something in the
you're
Midwest.
Probably thinking, I was going to say, probably like a Midwest or like an Alabama, somewhere where maybe you can pay $100,000 a unit for a property. No, that property is never going to be $2,000 in rent. I actually want to say this does not exist.
I would say if you're going to maybe potentially get that, maybe it's some kind of a single family home, but even then I'd say that it's still going to be a unicorn, now. 10 years ago, that might have been the case, right? Where, we talk about the 1% rule, right? But that's really the 2% rule. And I'd say that's probably going to be very challenging to find, but there's great markets. We love the Sun Belt, right? So that's, everywhere from Arizona through Texas down to Florida, all the way up into the Carolinas. We loved all of those markets, population growth, job growth, landlord, business friendly, tax friendly. It's got all of those boxes checked. So if you want a good long-term sub-market or markets to be in, regardless if you want to be passive or active, I'd look in those markets, right?
And maybe to add, kind of the same person says, he says he's finding that all over Indiana. Then he says, okay, gotcha, you guys don't know Ohio or Indiana. We've looked at some deals in Indiana, and yes, you can find apartments in the 100 and less price range. I just haven't seen anything with that high of rents at 100,000. So if you're finding it, and maybe it's in the smaller units, I don't know what size units you're looking at. I mean, that's a steal. I would buy that.
I would say go. I mean, if you're absolutely finding it, then go for it. The only thing that I would question, I mean, we like Columbus, Ohio. Don't know Indiana all that well, but the one thing that I'd have to say is, again, you need to look at the long term. Because if you're saying, oh, I'm buying these 8, 9, 10 caps, that's great, right? But just look at it on the back end, you're probably going to sell it at an 8, 9, and 10 cap as well, right? Yep. That's just what those markets are. They're higher cash flow, less appreciation. But I'd say, man, if you find those, go for it, for sure.
And keep going. We got one more question, and we'll keep going. So
okay.
The question is, brand new and first time here, where and how do you get initial funding using other people's money? I'm interested in multifamily units. Friends and family is the name of the game for everybody looking to start.
Yeah, I think that's probably your best bet. Then getting out to a lot of events, doing a lot of networking, right? Passive investors network just as much as active investors do. So you got to go out there and you got to invest the time to build up your investor database or your email list. And then you need to ultimately talk to that list. You need to communicate with them. You need to build rapport. And then ultimately, when you have an opportunity, right, you've already educated them. They're ready to go. They're ready to invest. But yeah, ultimately, your friends and family, colleagues, that's probably your best sphere. But typically, you're going to tap that out within 1 or 2 deals, and then you're going to have to go and do kind of more traditional marketing and networking and sales, approaches to that. Boom. All right. Well, we ran a little bit long, so I'm going to go blow through this. So we're less than a month away for MFIN, the Multifamily Investor Network Conference in Seattle. Can you believe it? The Beard, Mr. Brandon Turner is going to be with us, Tom Wheelwright, Robert Helms, and Mr. Neil Bawa, the mad scientist of multifamily. We're at about 80% capacity, so there is a few tickets left. So drop in, disrupt at the checkout, get your $100 off, investornetwork.com.
Prices will continue to go up. So definitely, if you want to get in, this is the right time.
Yeah. So we got several hundred people that are already going right now. It's going to be a great turnout, a lot of education, and most importantly, a lot of that networking that we were just talking about, right? So if you're here next Thursday, right, check it out. We're going to be back at Pitch 25 Beer Park. check it out with the registration, disruptequity.com/HTX meetup. This is our monthly meetup. We put it on every month. We're talking about multifamily passive investing panel this week. Oh, we got some hitters. Some people that are investing some money. So if you're in Houston, check it out. This is our meetup. We get about 150 people every month. Well, what's coming up next week?
Talking about Independence Day.
Oh my gosh.
We are not going to be here, so we're going to be out making, Ben's going to be grilling some food and bringing it over to my house to drop off, and then we're going to be popping up.
I'm going to be at the pool. But no, we wish everybody a happy July 4th. We will be back Monday, July 11th, so stay tuned. Look forward to seeing you then.
All right, thank you.